As you mentioned, markets have been very turbulent in recent weeks with a major sell-off across equity markets around the world. The primary catalyst for this sell-off seems to be heightened concerns around what's happening in China, both in terms of growth, but I think more recently people are questioning their confidence in policymakers in China, as we've seen a number of bungled efforts really to support the stock market, and also a lot of uncertainty with regards what they want to do with the currency, for example. And so people who've long believed that the Chinese authorities have all the tools and all the capacity to solve any problems that might be thrown their way are starting to doubt that. And with growth weaker these days, people are certainly worried about the prospects for China, which means they're worried about the prospects for emerging markets more widely in global growth. Equity markets had been quite elevated. That is now no longer the case, as we've had a material sell-off for most equity markets. Now, our view is that economic growth in the US, certainly in the domestic service sectors, looks quite strong currently. We've had some very good numbers for the services side of the economy. And similarly, Europe is picking up as well cyclically. So while there are concerns over Chinese growth, we think the growth conditions in developed markets look quite reasonable. And following a sell-off, we think valuations are much more attractive now versus cash or bonds. And so for developed markets at least, we think this is likely to be quite a good buying opportunity for investors in developed market equities. I think it may take some time for the dust to settle. There are going to be lingering concerns for China for a little while. And we prefer adding to developed markets at this stage than emerging markets because the fundamentals for emerging markets remain quite difficult. But broadly speaking, with stronger growth in the developed world and lower levels, we think this is a good time to be buying developed market equities. We've gone full circle really from all the hype and hysteria about emerging markets 5-10 years ago and how they were going to take over the world to now widespread pessimism. And I think when one steps back, you can see with a bit more clarity that the golden decade, if you like, for emerging markets was quite special in that China, being the largest economy, was growing very rapidly with industrializing, a lot of infrastructure spending, a property boom. That fueled a commodities price boom, which a lot of emerging market countries benefited from being commodity producers. And also a lot of emerging markets implemented better macro policy, so interest rate policy, fiscal policy, coming out of the crises of the 1990s. And so that combination of events at a time really of rampant globalization, so a lot of investment around the world and easy capital pre-crisis, meant that emerging markets could grow very rapidly. And I think coming out of that, the world environment has changed rather. So there's less growth in the developed world. So they're struggling to generate export-led growth. There was a huge boom in mining and oil extraction, which meant that commodity prices, as demand has fallen after a big uptick in supply, commodity prices have fallen very sharply. So that's bad for a certain subset of emerging markets. And I think there's an element where a number of governments believed their own hype and didn't continue to implement reforms or the right reforms for long-term growth. And therefore, when the tide goes out, as it has done in the last couple of years, they've been found wanting. And so this combination of events means that growth in emerging markets is under pressure. The relatively good thing in this current environment compared to, say, the 1990s is that most emerging market countries don't have pegged currencies, and therefore the currency takes the strain of weaker economic conditions rather than you having a very abrupt recession and crisis in specific countries. So it becomes more like a chronic disease rather than an acute problem, if you like. I think what will happen going forwards is that people should be less inclined to bucket all these countries together in terms of emerging market economies, because when one looks at the fundamentals of growth, you realize that it's very much up to the policies that individual governments implement as to whether they're successful in terms of economic growth in the long run, or not. And therefore, the different policies that different governments implement will lead some countries to deliver robust growth, and we think India is in that camp, and within Latin America we think Mexico is a bright spot on the reform outlook. But others, such as Russia or Brazil, where reform has been less good, they're seeing more pressure, and therefore we need to see better policies from their governments or changes in government for something to change there. So China is a very large economy now, second largest economy. What happens in China has big ramifications for the rest of the world. So it will mean slower global growth. It'll put disinflationary pressure on the rest of the world. The more China slows, the less likely the Federal Reserve or any other central bank, for that matter, is likely to raise interest rates. So interest rates will stay low in the developed world, which is one reason why people may tend to favour equities still over very low returns on cash in the bank, or indeed in the bond market. The Chinese currency will have a big impact on what happens to emerging market currencies. They've had a small depreciation so far, and the question is, are they going to have a much bigger depreciation, or are they going to carry on managing the exchange rate? And we really can't be sure at this point in time what will happen, but we would expect some depreciation going forward. So emerging market currencies generally may continue to be under pressure against the dollar, at least, and is probably likely that emerging markets in general will find the environment more challenging than the developed markets, which hopefully can ride their way through this turbulent period. Global growth remains fairly slow, and part of that is a slowing of population growth around the world. That is likely to continue. The other element is the fact that productivity growth has been quite slow, and we don't know whether that's a bit of a mystery. We don't know whether productivity growth is going to pick up or whether it's going to stay quite low. But so long as this remains the case, and as long as there is very little inflationary pressure, no inflationary pressure ostensibly at a global basis, interest rates will remain fairly low in the major economies, which means that returns on cash are going to be pretty low, and returns from the bond market are going to be low, although better than if inflation were to pick up sharply. So low returns from cash in the bank, low returns on bonds. Equity markets have appreciated over the last 5 or 6 years, but they don't look prohibitively expensive when you think about the low return on cash or the low return on bonds. And therefore, as long as the world can generate even a mediocre level of growth, and as long as interest rates don't rise very quickly, which I don't think they will do, then equities, if they can grow their earnings and grow their sales, equities will remain the asset class of choice, and while returns might not be stellar, they're still going to be better than elsewhere. At least that's our view at Ashburton.